I know it's a bit of a boring topic to get into, but life insurance is a very important planning tool for Canadians. And if you do have a family or loved ones in your life that would be very financially impacted if you were to pass away, this is something that's very important to learn. And in today's video, we're going to explain exactly how life insurance works in Canada. And by the end of it, you should know exactly what product would be best for you and which products you should definitely stay away from. What is up, guys? For those of you new to the channel, my name is Philip Sutter. I'm the founder and CEO of Affinity Life, where we've helped thousands of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. So if that sounds interesting, I'll put a link in the description below and you can check it out. But without further ado, let's just get right into the video. So life insurance is a pretty easy concept to understand. You essentially have a contract with the insurance company, and there's three major components of that. So number one is the policyholder. This is essentially the owner of the contract. So that's the individual that went out and bought the policy and owns that policy. Now the policy owner and the insured are usually the same person, but that is that second component. So you have the insured. So this is the person whose life is insured. And if that individual passes away, then the third component of that contract is the beneficiary. That beneficiary will receive a death benefit on a tax-free basis. Now in Canada here, we have three major types of life insurance. We have term life insurance, we have whole life insurance, and we have universal life insurance. Now term life insurance is the easiest type of life insurance to understand. It's the most inexpensive, and it's meant to cover you for a very specific period of time. So you can pick different term amounts. You could pick a term 10, a term 20, a term 30, even a term to age 65. Now with term life insurance, as long as you pay your premiums, you have that death benefit that will go to your beneficiaries in the event that you pass away. Now, once you get to the end of your term, you have three different options that you can choose from at that point. So the first option is you can just cancel your life insurance. You no longer need it at that point. Maybe you got a term 30 when you were, let's say, 25 years old. Now you're 55 years old. Your kids are out of the house. You know, your house is mostly paid off at this point, and you have some investments and you're doing okay financially. Yes, if you were to pass away, there'd be maybe a small financial impact, but not the same amount as it was before. So maybe you can just cancel that term life insurance altogether, or maybe you can cancel it and get a different term, maybe a smaller amount for a shorter duration or a shorter term. The second option you can do is you can renew your policy. So depending on what term you chose, maybe if you picked a term 10, that means you're going to renew it for an additional 10 years. If you picked a term 20, you would renew it for an additional 20 years. So whatever term you originally chose is what it will renew for. Now, when you do renew it, the premium is going to increase quite a bit, anywhere from 3 to 5 times the original premium, depending upon how old you are. So you ask, well, why would I renew it with them? Why don't I just shop the market and get a better rate at whatever age I'm at, or a better contract with another company? Now, the benefit of a renewal is they have to give it to you regardless of any adverse health conditions that have arisen over the past 10 or 20 years. So let's say you got a term 20 when you were 25. Now you're 45, you're going to renew it, but maybe you had a heart attack, or maybe you had some type of cancer. You can't go out on the market and get another policy. Well, you always do have the option to renew it with that original company, regardless of what type of health conditions have come up. However, that premium is usually going to be more expensive than it would be if you just went and shopped the market at that age. So if you're still healthy and you need coverage for a longer amount of time, it's probably better for you to go and just apply with another company at that point. However, if you need to renew it, you can do that option. Now, the third option that you have is you can convert it. So most carriers here in Canada with term life insurance will have the ability to convert that term life insurance into a permanent type of life insurance coverage. However, it does have to be with that carrier. So you can't have an RBC policy, a term life insurance policy, and convert that into an equitable permanent life insurance policy. You do have to do it with whatever company it is. So when you choose a term life insurance policy, you probably want to try and pick some type of company that does have some permanent options, just in case you do want to convert that later on in life. Now, the other two types of life insurance policies in Canada are whole life insurance and universal life insurance. And both of these are what's known as a permanent life insurance coverage, meaning that it's designed to last until the very end, whereas term is designed to last for a specific period of time, and the affordable premiums reflect that. Permanent life insurance is meant to cover you until the end. So it is much more expensive than term life insurance. Term is a what if for the insurance company. Permanent life insurance is a when, because they know they will have to pay eventually. So just to give you an idea of price, whole life insurance on average is anywhere from 20 to 25 times the cost of a term life insurance policy. So if a term life insurance policy is $100 for, let's say, $1 million of coverage, it's probably going to be anywhere from $2,000 to $2,500 a month for the same $1 million whole life insurance benefit. Now, with both whole life insurance and universal life insurance, there is this quote unquote cash surrender value or fund value, as it's known with universal life insurance. Now, with this value, you can kind of think of it like the equity within your whole life insurance or universal life insurance contract. So if you cancel your policy, they do have to pay this amount out to you. However, there may be some taxes that are applicable if they do. But the other option that you can do with this fund or this value within your permanent life insurance coverage is you can take a loan against it. Now, of course, there would still be an interest cost associated with that loan. And in some cases, there also might be taxes that are payable on that loan as well. However, if you do know that you want to leave something behind for the next generation, or you know that there's going to be a large estate tax that's due when you pass away, permanent life insurance could be a very good option for you to cover off those taxes when you pass away. Now, with these three different options of life insurance, you're probably wondering, well, which product is best for me? So I'll just kind of break it down here real quickly. Term life insurance, I think, is probably best for the majority of Canadians that are looking to cover themselves and their family for a specific period of time. So this is families, this is parents, this is individuals that are maybe in a relationship with financial responsibilities. Anyone that's looking to cover themselves for that specific period of time in the most inexpensive manner is probably going to want to go with term life insurance. Now, whole life insurance is a really good option for people, and I would recommend it usually around age 50 to age 60 that are now looking at their estate. They have their retirement taken care of. They know exactly what they have, and they say, okay, we have some left over now at this point. Maybe we should look at A, leaving behind something to the next generation. Maybe that's our kids or our grandkids. And B, we know that we're going to have some taxes due upon death. Maybe we have some extra rental properties, some extra investments that we don't need for retirement. Let's get some permanent life insurance coverage in place to take care of that tax bill. Now, you've probably seen quite a few videos on social media talking about using life insurance as an investment, be your own bank, or use life insurance during your retirement. And here's the thing, I've made a dozen or 2 dozen other videos on my channel where I compare this life insurance as an investment strategy against much more simple things such as your TFSA and RSP. And what I found is that for most individuals that haven't already utilized those accounts, you're going to have a way better deal and you'll have way more left over at the end of the day if you use those strategies as opposed to this life insurance strategy. However, for the minority of Canadians who have already maximized these accounts, and specifically for business owners that do have some retained earnings in their corporation, it could be a good idea. However, using life insurance as an investment for the majority of Canadians, I don't think is a good idea. I think it's a waste of money, honestly, and I think that investing in much more simple forms such as your TFSA and RSP is probably going to be your best bet. However, if you are looking towards some type of estate planning, not using life insurance as an investment, just using it as an estate planning tool, whole life insurance and universal life insurance in some cases can be a very useful tool. Now, I hope that's not too confusing, that I haven't lost you guys completely. If you guys have any questions or if you want to know more information, feel free to reach out to me personally and we can book a meeting and chat further. Or if you have any other questions or comments and want to drop them below, feel free to do that. And as always, if you guys are enjoying this content, all I ask is you give it a thumbs up, and I'll see you guys in the next one.